Hello, everyone. It's great to be here. I think I'm talking to you for about 10 minutes, and it's been raining solidly every day in England for the last 6 weeks. So a bit of South African sunshine outside is fantastic. It's also very nice to be in a room of financial advisors and planners. My father was a financial advisor, and he started his business in the basement of my family home. So I sort of grew up above the shop, so to speak. And one thing I really learned from him is that when you're investing with people, you want them to be very clear about what they do, and to do that sort of consistently over a long period of time. And you also want to be able to trust them and to build relationships with those investors. And that's very much what we've looked to do at Evenload. So I have been a fund manager for 25 years. I co-founded Evenload 17 years ago. And we're independent, we're employee owned. And the only thing we do is invest in the shares of quality companies. And we also look to communicate very clearly with our investors along the way. And the two things I want to do today are firstly to explain our approach. There would be no one that would stand up here and say their investment process is to invest in crappy companies. So what do we mean by quality? And then the second thing I want to talk about is that we think the opportunity set within our universe of quality companies at this present time is the best we've seen since we founded the firm about 17 years ago. So the fundamentals of these businesses are very good. They're growing at a good rate. They're spinning off a huge amount of cash, but the market's not interested in them at the moment. There's been these two incredible trades of the last 5 years, and particularly the last 2 years. On the one hand, you've had big rallies in things like banks and commodities. And then on the other hand, there's been this great sort of trade in the US to do with the AI capex boom, and that's left these businesses on very compelling valuations. Now, the guy on this slide is called Pacioli, and he is literally a Renaissance man. He was mates with Leonardo da Vinci, and he lived with him in a flat in Florence. He was also a Franciscan friar, a mathematician, and he wrote the first book on double entry accounting. And in that book, he mentioned the rule of 72, which some of you may have heard about. And if you approximate if you take your annual compound rate and divide it by 72, that is approximately the length of time that your investment will take to double. So if you look at this chart here, it's got 8%, 9%, and 10% a year. Now 72 divided by 8 is 9, so that would mean at that rate it would take 9 years to double, 9%, 8 years to double, 10%, roughly 7 years to double. And I sort of think of myself, or at least my aspiration is to be a 10% guy. So the UK strategy that we've run for nearly 17 years has done about 10% per annum. It doesn't make you the most exciting person at the cocktail party, but if you're doubling every 7 years or so, you double again, and you've got what Peter Lynch would have called an 8-bagger over 20 years. And the way that we look to do this, and this is the fundamental algorithm as we see it, is we're investing in the shares of companies, and we want the bulk of the return to come from those businesses and their performance. So there's a bit of income, and then it's roughly 2% for this global quality strategy. And then we would expect the per share earnings and free cash flow to grow certainly at a high single-digit rate over time. And it's those two elements that get you to that total return. Now, the issue over the last 18 months has been actually the earnings have been growing very strongly, 15% last year, forecast to be similar this year, but the valuations have come down, and that's been a weight on the total return. But that's what's creating the opportunity set today. Now, this is a long-term story. I'm sure you're familiar with the UK company Unilever. I write a monthly investment view. And one of my clients wrote to me, and he'd been to see his grandfather down on the coast on the south of England, and his grandfather had bought 700 shares in Unilever on the 1st of August 1966. So that was £1,000 at the time, worth £25,000 in today's money. He was quite a young man when he purchased them. He's now into his 80s, and he just put the share certificate in a desk drawer. Didn't do anything with them since then. And you can see a completely different time in the world. The Beatles, from Gary's hometown, had just recorded the Revolver album, and they were about to record Sgt. Pepper's Lonely Hearts Club Band. You can see our Prime Minister, Harold Wilson, at the time smoked pipes. That's how long ago it was. And you can see the Unilever brands here. And I think actually Unilever's been in South Africa since the 1890s, in India, for instance, since the 1880s. So this is a business, and this is how we define quality. We're looking for a durable competitive advantage where it's very difficult for new entrants to come in. We're looking for structural growth that the business can benefit from, and we're looking for a management team that invests in the health of the franchise and the growth opportunities over time. We also have technical definitions of quality, which I won't bore you with. We have, long-term financial models. We have a proprietary software system. We're looking for high return on invested capital, a low capital intensity, and low leverage too. So Unilever has a fantastic portfolio of brands, and it also has this incredible distribution across the world. And I in fact, saw an advert in Nelson Mandela Square in Sanford on Monday for Sunlight, for instance, and you can see Sunlight here, and Lux, and Omo, etc. Now, how did my reader's grandfather do over this period? So you can see the performance of the Unilever shares on this chart. So that £1,000 over that 60-year period compounded at about 10% per annum. There wasn't really any change in valuation, so that was all generated by the fundamentals. And that £1,000 turned into £300,000 just in terms of the capital over that 60-year period, and that's versus that £25,000 in real terms. So a great sort of story of long-term compounding. The dividend today is £10,000 on that £1,000 investment. So again, it kind of reminds you of that long-term ability for these companies to produce wealth for you. And if you think about everything that happened over that period, the two oil spikes in the 1970s, the 1987 crash, you can see a dip there in 98, 99 when this business was less fashionable in the TMT boom, but the compounding has continued. I think the other point to make is, even though it's a good business, no business can stand still. There's no such thing as a perfect company, and the world moves on. You get technological change over time, and Unilever has had to change. It was primarily a food business in the 60s. It's had to keep investing. It's disposed of parts of its portfolio that became less compelling. It's made bolt-on acquisitions, and it's continued to invest in its future. But a great quote here to sum up that basic point in terms of what we're trying to achieve from the sort of father of value investing, Benjamin Graham. In the short run, the market is a voting machine, but in the long run, it's a weighing machine. So if the fundamentals come through, ultimately the share price is dragged along by those fundamentals over time. So in terms of even load, we we work in a very beautiful part of the world. It's the Cotswolds. You can see the river on this photograph, which is the Evenlode River, and we run 3 strategies, including the global equity strategy, and manage just under $7 billion of AUM. If any of you are ever in England, feel free to drop by on the way up to see Gary in Liverpool. It's not far from London, very nice part of the world. And in terms of our process, I won't go into this in great detail, but we do a huge amount of fundamental work in terms of peeling back the layers of the onion to get to know these businesses. And you can see 10 of the key risk factors we look at. And I would just highlight 3 of them that are super important. One is the moat strength. One is so that's the durable competitive advantage. One is the long-term outlook. And one is the cultural quality of the management and whether we feel they're investing properly back into the business. And we score all of these 10 risk factors, and that helps us determine a position size for a company. And if we're not happy with the fundamental risk, we may well reduce the company or sell it. The other lever we've got to pull as active managers is the ESG factor. So we spend a lot of time engaging with the boards and the executive managements, discussing, governance, capital allocation, strategy. And if we feel that a business isn't properly investing in the future, or if, for instance, we don't feel the capital structure's appropriate, it's got too much leverage, we're always giving constant feedback to the companies on that. I think just a really good example over the last 2 years has been obviously this huge change with the sort of generative AI technology, and there's opportunities and there's risks that produces to pretty much any company in the world, and we've done a sort of unhealthy amount of work on that. So we speak to a lot of experts that have worked at companies, that have worked in the sectors that the companies operate in, technology experts. We also obviously talk to the companies themselves, and then to analysts who are experts in the sectors as well. And I think, Christina, my colleague, will touch on this in the Q&A session, but as one example, we think there's been this quite indiscriminate sell-off in companies that have digital business models, and we think there's some very interesting opportunities there for sort of information service companies that have very strong proprietary content, the baby has been chucked out with the bathwater, and we think those are very good businesses that are growing at a good rate, are actually beneficiaries of generative AI in many ways, but are currently trading on very interesting valuations. So then just to finish, valuation is also very important for us, not just the fundamentals of the company. I think this example from Cisco is just a great example because it's a pretty extreme one in that the price to earnings multiple of Cisco in the late 90s was at 100, and it's an excellent business, Cisco, and it's grown its earnings by 9% per annum since then, but the share price has only just got back to where it was back in sort of 99, 2000 because the stock has been derated over time. And then on the current backdrop, you can see here the discount that the free cash flow yield on the portfolio has relative to the MSCI Global. And you can see it's the sort of cheapest that it's been for the last 15 years or so, but on a forward-looking basis, it's even more extreme. These businesses are spinning off huge amounts of cash, and the free cash flow yield is over 5% for the portfolio. The MSCI Global is only about 3% at the moment. And these are excellent quality businesses, going back to our definition of quality, thinking about return on invested capital, how profitable these businesses are in terms of gross margins, operating margins, the strength of the cash conversion, and these businesses have low leverage as well. So you're getting a portfolio that's very high quality, but it's much cheaper than the global stock market at the moment. And as I said, the earnings and the free cash flow per share are still growing at a very good rate through this time. It's also a very diversified portfolio of equities. So we've got everything from Nintendo games to L'Oreal skincare to financials like MasterCard to business-to-business information service providers like Relex, the New York Times, and even Hasbro, what people think of as a toy company, but it owns this very successful franchise called Wizards of the Coast. So a real range of different business models that are contributing to the cash flow. And then just to finish, there's a Mark Twain saying that history never repeats itself, but it does rhyme, although apparently Mark Twain never said that. But I do think there is some pattern recognition with the late 90s. I'm definitely not predicting that the Nasdaq's going to fall in the way that it did in the few years from 2000. But I think there is we're in a period of the market where the sorts of companies we invest in, they're Buffett-like companies, and Buffett was sort of written off as a grey-haired old fuddy-duddy in the late 90s for investing in these businesses that have durable competitive advantages, partly because they were too boring relative to some of the technology shares, and in some cases people were worrying about disruption risk. And you can see here, just as an example, the consumer staples sector was obviously down during sort of 98, 99 in a period when the Nasdaq more than doubled. Now, then, in the next sort of couple of years, the old economy didn't die. These businesses are market leaders that pivoted and invested in the internet, harnessed it for their own businesses. And you can see people were reminded of the qualities of these businesses when actually the Nasdaq had a very poor period. And I think, there's a more general point here. I don't want to mention the R word in a conference like this, but and I'm certainly not predicting a recession, but I think we've only really had one global recession since 08-09, which was the COVID downturn, and it was very short-lived, and it was sort of short-circuited by fiscal stimulus, and then obviously the invention of and the rollout of the vaccines. But these sorts of businesses, they do have very repeat purchase cash flows. Going back to my point, they also have low leverage, and they're also self-funding, so they can invest with their own internally generated cash flow. And I think during periods when investors are more worried about downside risks, going back to my English weather and the rain, these companies act as your umbrella in the golf bag. So that's it. Thank you.